Long bond TLT is finally rallying. Can it last? Why Jerome Powell did not pivot yet. It was such a mind-melting experience trading in this market this week. Everything is going up. Stocks, bonds, oil, gold, and silver. Except for the dollar. It's all because of something Jay Powell said. What did he say exactly? Is this the Fed pivot that everyone is expecting? TLT rallying up huge in just a couple of days. Does that mean deflation forces are getting stronger? If so, then why is the oil price going up too? It has went back to the 80s range again. Gold and silver just went up too. Does that signal inflation is heating up the place again? Which signal should you trust? Or you should just follow the chart and wave structure. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you're a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get it into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? Federal Reserve Chair Jerome Powell provided a clear signal that the central bank is on track to raise interest rates by a 0.5 percentage point at its next meeting, stepping down from an unprecedented series of 4 0.75 point rate rises aimed at combating high inflation. Mr. Powell, in a speech Wednesday, said an overheated labor market needed to cool more for the Fed to be confident that inflation would decline towards its 2% goal. Because the Fed has raised rates rapidly and it takes time for those moves to influence the economy, it would make sense for officials to slow rate increases. The time for moderating the pace of rate increases may come as soon as the December meeting. Fed officials lifted their benchmark rate by 0.75 percentage point on November 2nd to 4%, which is up from near zero in early March. Many officials have signaled they are leaning toward approving a 0.5 point increase at their December 14th meeting. Mr. Powell suggested Fed officials were moving into a new phase of policy tightening in which they would try to judge just how high rates need to rise. My colleagues and I do not want to over-tighten because cutting rates is not something we want to do soon, he said. That's why we're slowing down and going to try to find our way to what that right level is. Mr. Powell reviewed signs of progress on the inflation fight, including a slowdown in interest rate sensitive sectors of the economy such as housing, and improving supply chain conditions. But he said that declines in rents and goods prices might be insufficient if firms don't slow their hiring to bring the strong demand for labor into better balance with a shortfall in the supply of workers. Labor demand has eased some in recent months. Job openings totaled a seasonally adjusted 10.3 million in October, the Labor Department reported Wednesday. That was down from 10.7 million in September, but far exceeded the 6.1 million unemployed people seeking work in October. The labor market shows only tentative signs of rebalancing. The wage growth remains well above levels that would be consistent with 2% inflation. Mr. Powell said, "Despite some promising developments, we have a long way to go in restoring price stability." The Fed has raised interest rates this year at the most rapid pace since the early 1980s to battle inflation that is running near a 40-year high. Officials seek to reduce inflation by slowing the economy through tighter financial conditions, such as higher borrowing costs, lower stock prices, and a stronger dollar, which typically curb demand. The U.S. economy shrank slightly in the first half of this year, but grew more briskly in the third quarter than previously estimated. Gross domestic product increased at an inflation-adjusted annual rate of 2.9% from July through September, up from an initial estimate of 2.6%. The Commerce Department said Wednesday, "A wave of layoffs has rippled across industries such as tech, entertainment, and real estate." A big question now for the Fed is how much further to raise rates. Some officials are concerned about causing unnecessary damage to the economy and labor market because it takes time for the full effects of those increases to ripple through the economy. Other policymakers are concerned that price pressures could stay high because, despite improvements in supply chains and commodity markets, prices have picked up for more labor-intensive services. Mr. Powell pushed back against concerns that the Fed was raising rates too aggressively by warning that allowing rapid price increases to persist could cause consumers to expect continued high inflation, making it more entrenched. "It can't be that. We can go on for 5 years at a very high level of inflation, and that it doesn't work its way into the wage and price setting process pretty quickly. That's a serious concern," he said. Mr. Powell repeated his earlier view that officials were likely to raise rates to a somewhat higher level early next year than they had anticipated in projections released after their September meeting, when most officials saw their benchmark rate rising to between 4.5% and 5%. Mr. Powell focused part of his remarks on exploring why the share of Americans seeking work remains below level. The analysis carries important implications for setting interest rates because if wage pressures remain stronger in the coming years, that could lead to a period of greater volatility in wages, inflation, and borrowing costs. Steps to boost workforce participation aren't controlled by the Fed and wouldn't be able to take effect rapidly enough to address the current bout of high inflation, Mr. Powell said. The upshot is that Fed policy will seek to slow inflation and wage growth by reducing demand for workers, a subject that Mr. Powell addressed delicately on Wednesday. For the near term, a moderation of labor demand growth will be required to restore balance to the labor market, he said. While strong wage growth is a good thing, he implied, it is too high right now to support a return to the Fed's 2% inflation target. For wage growth to be sustainable, it needs to be consistent with 2% inflation, he said. Mr. Powell said the Fed's preferred measure of inflation, the Personal Consumption Expenditures Price Index, rose to 6% in October from a year earlier, down from 6.3% in September. When stripped of volatile food and energy prices, the so-called core index likely increased to 5%, down from 5.2% in September. Separately, Treasury Secretary Janet Yellen said on Wednesday that inflation could come down without broad layoffs occurring across the economy if companies slow hiring by reducing the number of unfilled jobs they are trying to fill. The Labor Department is set to release its November employment report on Friday, which will include details on hiring, wage growth, and joblessness. The unemployment rate stood at 3.7% in October. A jobless rate between 4% and 5% would still indicate a robust labor market, Mrs. Yellen said at a New York Times event. I think we can make a lot of progress in the labor market just on the hiring and job opening side. I don't think it's necessary to see very substantial layoffs, she added. Clearly, she doesn't want another recession on her hands. But the bond market disagrees. As TLT rallied up 2.96% to a high 105 on Thursday. The smart money is lowering the long-term bond yield as the Fed is going to raise short-term yield, making the yield curve even more inverted than 2008. Meanwhile, the smart money is taking profit from this final bear market rally, while the dumb money is thinking a new bull market just started. And let's go back to the moon, just like in 2021. Really? The fear and green index is almost showing extreme greed. It recorded a reading of 72 on Thursday morning. I know S&P 500 has crossed 200 day moving average. Be patient. Wait for an opportunity. You can certainly trade in this market, but it's definitely not the best entry point for an investor because the Fed did not pivot just yet. When he does, we will have a deflationary crash. And TLT will make some real moves higher. I know it's not the Fed's intent for the market to rally because it will make inflation so much harder to kill. It's the trader that front-run the Christmas rally. Can it last? We will have to just wait and see. And my client Taddy Eazzy's book, Wicked Pussy Perfume, it is an erotic novel, such an amazing book. Order your copy today for someone for Christmas. And my clients David, Vine, and Jama, their book is called Ignite the Passion, Co-Create Your Dreams, another awesome book. Order your copy for Christmas. You are such a good boy for watching my video right till the end. Bye.